Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Are you a new or experienced investor wanting to learn how to have a successful syndication business? Learn from the nation's leading syndication expert, my friend, Vinny Smile Chopra. He has created a multifamily academy where you will learn everything about deal analyzing to selecting emerging markets, managing assets, and much more. In the academy, you'll find over 500 lectures and templates to help you run a successful syndication business. Your membership also gives you access to Vinny every Wednesday through masterminding and coaching calls. Vinny came to the U.S. with only $7 and now is a CEO of 5 companies, acquiring and managing a portfolio of more than 3,500 units. He's completed 26 successful syndications ranging from 50 to 500 units and created a portfolio valued over $200 million in commercial real estate. He built the academy to teach and mentor investors like you to succeed. To learn more about the Multifamily Academy, text LEARN, L-E-A-R-N, to 474747 or call his team at 925-766-3518. This is your Real Estate Syndication Show. I'm your host, Whitney Sewell. Today, our guest is Toby Mathis. Thanks for being on the show, Toby.
Thanks for having me.
Toby is an attorney that helps investors and business owners keep more and grow more. He's a founding partner of Anderson Law Group. He's helped Anderson grow its practice from one of business and estate planning to a thriving tax practice and registered agent service with tens of thousands of clients nationwide. He teaches a popular bi-weekly webinar entitled Tax Tuesday, where business owners and investors can ask any tax question. Wow. So you can ask any tax question and they, they have answers. They answer them on the air. It is just Toby and a CPA who answer and turn the recordings into podcasts. So that's a valuable resource right there. I know you have, you've done many other great things, amazing things, but I know the listeners would love to hear more from you. But tell them a little more about who you are, Toby, and let's dive in.
Yeah. Hey, thanks. The Tax Tuesday, by the way, is one of my favorite things is because I don't have to keep track of my time. I can answer any question. I don't care whether it's a CPA or an attorney or just a layman out there just trying to get an answer that they can never seem to get out of their tax guy. We just go through them. It's a lot of fun. But a little bit about myself is I'm an active real estate investor. My partner and I have everything from commercial buildings to warehouse to about 130 single-family residences. I believe that you can't teach something unless you do it. And so I figured this out pretty early on in my career that there's a lot of attorneys and accountants out there that talk a good game but really don't understand. Like they learn it out of a book, but they don't understand how it works in the real world. And so I just, I believe you learn by doing. And so I felt like, hey, I had to do what all my clients have done. And it just happens to be that I think real estate's one of those investments that's called an infinity income. It'll pay you for life. It'll pay you beyond the grave if you want to leave it to your family. It's just a fantastic investment. And so I'm a big proponent in it. And just because I'm a big proponent in it means I've done it myself and I've experienced these things and I know the nuances of maximizing keeping it away from people that are trying to take it away from you from time to time, and also minimizing your taxes.
Awesome. Well, you're an ideal guest for the show. I really appreciate your time. And but let's get started as far as talking about that tax that we all are having to pay, or hopefully we're paying as least amount as possible. But as far as maybe the passive investor and thinking about that income that they're making from these syndications and some of that, get us started with just thinking through that tax process or burden and what we can do.
Yeah, so so the way I look at tax is that there's 2 roads, and so I use an analogy when I teach quite often that seems to make sense, which is a lot of folks have flown into Orlando Airport to go to Disney World. If you've ever done that with kids, you know what it's like. You fly into the airport, you get a rental car, then you follow the signs that take you to Disney World, and along the way you hit about 5 or 6 toll booths. Well, that's road number 1, and that's the road where all the signs will point you. There's Sand Lake Road running parallel where you don't have any tolls that'll still take you to Disney World. The only difference is one person knows, the locals know that there's this non-toll road, and the rest of us all ride on the toll road, and taxes are the same way. taxes, it's kind of funny. I grew up and went to Catholic school, so I learned Latin. So taxes actually means to censure or express severe disapproval. So I always look at tax as kind of like getting whacked by one of the sisters for goofing off in the back of the class. And, you get hit with it long enough. Eventually you should be saying, hey, wait a second, maybe I don't want to get hit. Maybe I want to get an accolade. Maybe I want someone to say, good job. And the taxes, they have certain types of income where they give you that little noogie, that good job, that attaboy. And that's passive income. Passive income, you avoid one of the biggest taxes that's out there, which is old age, death, and survivors and Medicare, commonly known as the Social Security tax. You don't pay it. And in addition, you could actually own real estate and never, ever, ever pay tax on it, you or your heirs, if you do it right. Because you can just 1031 exchange it, and then when you pass away, the basis steps up. So, not getting too technical, but that just means that you don't have to pay tax. Your kids don't have to pay tax if you leave it to them. The grandkids don't have to pay tax if you leave it to them. Like there's real estate's really it when it comes to it. Now you could do that with stocks too, but there's very few items that are out there where you can actually buy and sell and not pay tax. And real estate is the only one that falls under 1031 exchange now, where you can actually sell your real estate, buy more, and pay zero tax.
Wow. Well, okay, you got my attention, right?
Mm-hmm.
So, I guess move us forward in some things that we need to understand as a passive investor, even as a syndicator, to understand the best ways to pay the least amount of tax.
Yeah, so it's very interesting. If you go back in history, and again, if you like taxation, like learning about it, and because you realize it can increase your income, then this is going to be interesting. If you hate taxes, you just don't want to know anything about them. You're like, I hand my stuff to my CPA, then you can just ignore what I'm about to say. But if you look back at the history, prior to 1986, rich folks would just buy a lot of real estate, and they would use the deductions that you get for the real estate, which is called depreciation, and they would offset their active income. And that is still there for certain people. If you are an active real estate investor and you qualify as a real estate professional, you could still wipe out all of your other income through real estate. If you are just a passive investor, for example, if you're in a syndication, you still get the benefit of that depreciation. It's just you can't write off your W-2 income with it. But it's still a really powerful tool because you could have income that's coming in and you're just not paying tax on it. And so I'll explain how it works real quick. If I had a piece of property, like a house, there's the land that the house is on, and then there's the actual physical building. And the way the IRS looks at it is they say, hey, that physical building is going to have to be replaced every X number of years. If it's residential, they say 27 and a half years. If it's commercial, they say 39 years. And so you write off 1/27th and a half of that property, the value of that improvement, just the actual structure. You write that off every year against your income. So if I have a $275,000 house, that's the value of the improvement, I'm getting a $10,000 deduction every year, whether I want it or not. Like I could take it or I could choose to not take it. I'm still going to end up having to pay tax on it eventually, unless I 1031 it or unless I keep it till I die. But that's a huge benefit. If it's generating $10,000 a year, then I would pay zero tax on that $10,000. Real estate's really interesting from that accord. And what a lot of folks don't realize is that the IRS gives us that starting point, the 27 and a half years, or in commercial 39 years, but you don't have to stick to it. You could actually choose to depreciate a big chunk of that in year one by doing a cost segregation. It's really weird. Only in real estate can you do this. You could literally create something that has a nice, steady cash flow. The money's coming in, but it's tax-free income. And to me, in my world, that's like, hey, you got to really factor that in to determine what's your actual return. Because I could make $10, but if I have to pay 50 cents of it, like let's say I live in California and I make $1 and I'm a doctor and I'm making good income anyway, I'm getting 50 cents on the dollar. You have real estate, I'm getting $1 on the dollar. You start looking and saying, where should I be spending my time? What should I be investing in? It's going to be things that you don't pay tax on. Otherwise, it's just heaping into your tax level.
Wow. Okay. So, so the syndication business specifically, investors obviously investing passively, help them to pay less taxes and, give us some more pointers as far as what they need to know or do.
Yeah, absolutely. So when you're when you're investing, like I'm an accredited investor or non-accredited investor, and I buy an interest in a syndication, there's two sides to this. First off, There's the asset protection side to me that says, hey, you want to protect that. You want to make it so nobody can ever take that from you. So I'm always going to create a vehicle for that, usually in a state like Wyoming or Nevada, where somebody could never take it from me. From the tax standpoint, I always use the adage, first, do no harm. Like, make sure that you don't lose all the benefits. So if you have a good syndicator, they're going to go in there, they're going to do the cost segregation, they're going to depreciate that building, they know what they're doing. You're going to end up with a bunch of losses. You want that to flow right onto your page 2 of your Schedule E. You don't want to mess around with this. You want to make sure it hits you, no matter what. Even if it goes through another entity, another partnership, maybe it's you and a group put money together and then you invest in the syndication through that group, you still want it to hit your return because you get all that depreciation. And you can, and if you have other properties, the beautiful part is you could aggregate all your properties together and you could create losses that offset your syndication income, so you pay no income. Again, there's just so many tools in our toolbox when you are a syndicator, when you invest in real estate.
Wow. So it's going to benefit us. I mean, the more properties, it's going to help us as a passive investor. If I have other properties, say single families, as well, but I'm investing passively in some syndications, my tax preparer, my CPA needs to understand that, we can pull all these together.
And a lot of them don't. That's the scary part, is that there's been studies done on it. I don't want to freak everybody out, but if you're using a chain preparer, I can just tell you that the Treasury Inspector General already did a study, and they had a 0% accuracy rate on business and those types of returns. The Schedule C's and E's and D's, they literally screwed them all up. So I wouldn't go there. If you go to a regular CPA, they were slightly higher. I think it was 4% accuracy rate. So you just really want to be with people that actually do real estate and understand the nuances, because they're going to understand when I say aggregation, it's an election you have to make. They understand when it's appropriate, when it's not, because there could be a downside to it too. They just have to understand what your situation is, and they have to understand how depreciation works. And more importantly, let's say that you're investing in a syndication through a qualified plan, like your IRA. They have to understand the difference between an IRA and a 401k and a 401a for whether or not you have to pay tax on any of that income. And here's the hidden bomb that the IRS knows about that most people don't. If I invest through an IRA and there's any debt on the building or the property, let's say I do an apartment syndication, let's say I do a commercial building and there's loans involved, then that's called unrelated debt finance income. And I'm going to get hit with a tax on that portion of the income that's being derived from the debt. Only in an IRA. If I instead roll that IRA into a 401k, my own 401k, I could set one up off of any business I have, then I don't have to pay that. Just knowing that could save somebody a significant amount of tax hit every year. But I'll tell you what, most of the accountants out there, they don't get it. Most of the attorneys out there, they don't get it. You got to deal with people that actually do real estate. That's why I always say the first question you ask your attorney or accountant is, do you invest? If they don't, then I'm not saying they're bad. I'm just saying that you may want to look for somebody who does.
So tell me about that relationship between like my CPA and somebody like yourself, or, when do I contact, a tax attorney that specializes in taxes, and what does that look like on my team?
All right. So first off, understand that Anderson is not just a bunch of attorneys. We have CPAs, EAs, bookkeepers. We do it all under one roof. We just don't want you to bounce back between accountants. We still work with local accountants. Like if you have an accountant that you love, fantastic. What we are a 10,000 foot view company. We look at the structure that you're putting in place. When I do an estate plan, I'm looking at 200, 300 years out. I don't want to do something that just give it to your kids. Statistically speaking, you have about an 82% chance of failure if you give a bunch of money to somebody who's not used to it. It's 84%, excuse me. It was 84% under the last study done by Ohio State, and I think Duke got involved in that study, and they found that about 16% of the money was kept after 5 years. I just don't believe it. So we create plans that are long haul plans, and we look at the tax implications and make sure that, again, you don't do any harm to yourself, and that you're keeping your tax to the absolute minimum. And so I can give you an example. Let's say you have a fantastic investment that you put your money in. You went and did a syndication, and it's kicking out some serious money every year. And we have a lot of clients that are in that situation. And the syndicator isn't a tax syndicate. Like, they're not looking at the tax. They're just creating cash flow. They're fantastic operators. Like, let's say that you went into an apartment complex and you have crackerjack operators that are kicking off some serious money on your investment. We look at that and say, what's your tax appetite? Are you okay having that hit your return? Do you need that money? Or do we need to do something, buy something that will offset the tax on that? And somebody might say, well, what could you get? Well, you can get a single family house, $300,000 house, or get, 6 properties, little properties, if you need to do it that way. You could get properties and then cost segregate them to create tax loss in year one that then you could use to offset that income. It's just a matter of looking at the numbers, but somebody has to know enough to ask you that question and say, hey, look at this. So if you're in the highest tax bracket and you're in a state that charges income taxes, you have a huge tax appetite. You don't need that income hitting you, and there might be easy ways to avoid it. And so we're always looking at where you invest, what you invest through, and then what type of income it's kicking off, and whether there's anything that we can do to generate losses to offset it. So it's like, it's not all said and done. When income's hitting you, it's not a done deal. You can make it to where it's non-taxable, or you could create tax deductions. I could create a tax deduction tomorrow just by, if I have my own nonprofit, I could just give a big chunk of money to the nonprofit, or better yet, give a piece of property or give appreciated stock. I could create losses if I need to, or deductions if I need to offset my income. There's tons of ways to do it.
Well, let's talk about that. But I wanted to mention also, like how you mentioned, y'all are looking at, 200 to 300 years out. It's not just like today or this tax year. You're looking at, the taxes my children's going to have to pay as well. That's so important. And so, because I'm not even going to know, the best way to plan for them, unless I'm talking to somebody like yourself, or I'm going to have those questions, and it's great that you all are thinking about that.
Don't give it to them. Give them access to it if they need it. That's what I always say, is don't let them just, if I dump $1 million on somebody who's not ready for it, watch them make lots of bad decisions.
Yeah.
It's usually a Ferrari or a couple ex-wives.
So you mentioned nonprofit, and and how you could just create that deduction right tomorrow. So and I know we had discussed like a lot of people will start creating nonprofits and things like that, and it's something we are in the process of doing, not because we've made a bunch of money, because we want to give a bunch, and so tell us about that. Why is that something that people are doing now?
It's something the rich have always done. Whenever you look at, if you look at the ultra wealthy, there's not a single one out there that you could point me to that does not give a lot of money. And a lot of times it's through their own organizations. A lot of times we have a gap. We want to create value, and the value that we create is oftentimes doing things for those that can't help themselves. And so nonprofit just goes hand in hand with successful people. Again, this last presidential election, you had the Clinton Foundation and the Trump Foundation taking center stage in many cases, and they may still make a resurgence here in the near future. You never know, because sometimes they're shakily used. But the real thing is like something involving real estate, for example. Let's say that you're providing housing and you really care about veterans, you care about single moms, or you care about people that are transitioning out of any bad situation, single moms or jail or anything, and you're buying houses that serve that community. Section 8 actually qualifies as a charitable activity. Like, you could actually run that through a charity. A lot of people don't realize that charities is not just giving money away. Charities make a lot of money. In fact, some very, very valuable charities, the most valuable in the world is probably the one that was set up by the owner of, the founder of IKEA. IKEA is owned by charities. People oftentimes don't realize that that's what makes it so valuable. Bill and Melinda Gates, there's another one. There's just tons of them. Hershey Foundation is another great one that was started in 1905. Milton Hershey had no kids. He and his wife had no kids, but they created an orphanage. A lot of folks don't realize, and in Lancaster County, you have a hospital, you have a museum, you have a cemetery, you have this orphanage that was all created over 100 years ago by somebody who had no family, and it was all done through a charity. It's worth over $12.6 billion now because it doesn't pay tax. It gives away a ton. So we can use that same things for ourselves. A lot of folks don't realize that that's available to them. And the reason that you use it is because, hey, if I have a house, like for example, I'll use real life situations. You'll have a client that has some low income housing. Well, the houses they bought for a song, like here in Vegas, you could buy, during the downturn, we could buy a house for 30,000 that's worth 300,000 now. Well, if I give it to my charity, I get a $300,000 deduction. I don't get what I paid for it. I get what it's worth. And I can offset my income very easily that way. And then I leave it in the charity. If the charity wants to sell it, fantastic. It could still benefit me. I could draw a salary out of it if I want to. It could do good things. But instead of me like giving after tax, trying to get a deduction after the standard deduction, if you guys know what that is, I'm trying to get a benefit from my giving. Here's an easy way to get a huge benefit. And I'm still in control of the money. And I can actually do that. If I want to give it to my church, I can. I'm not worried about the deduction anymore because I've already gotten the deduction. I'm just giving cash now, but it doesn't matter to me. I can go ahead and take care of those organizations that I care about.
Interesting. So then you're giving from the nonprofit to take care of these other organizations instead of.
Yep. We call it getting lumpy. Like last year under the Tax Cut and Jobs Act, they increased the standard deduction. So unless you give enough to where you're above that $24,000 mark, with your mortgage, interest, gone. Miscellaneous itemized deductions are gone. They actually took them out of the code. So unless you're getting these other areas, health expenses that exceed 7.5%, unless you're going above that $24,000 mark, you get zero benefit for your giving. And so what we tell people is, hey, set up your own and then give one chunk every 3 or 4 years, and then take the standard deduction in the years, in other years. That way you get that 24,000 no matter what. And then in every few years, when you give 50 or 60,000, let's just say, you get a big tax deduction. And, in the other years, you're getting the 24,000, but now it's in your own organization. And then you could give it out over time to your church or to the other organizations that you care about. What seemed to happen is there was punishment for those people that tithe. There's punishment for those people that are just right around that standard deduction. They got zero benefit. And as a result, personal giving went down. Personal giving went down by by a big chunk. I think inflation adjusted, it was 3.6% that it went down, billions of dollars. But what was interesting is foundation giving by the actual foundations themselves went up. And the reason being is because guys like me tell people, hey, set up your own, give a big chunk of money to it, and then use it to give away. They're figuring a way to still get the tax benefit, even though Congress did its best to punish us.
Wow. So as before we run out of time, before we have to move on, but I wanted to ask you, as a syndicator real estate investor, who should, or when, I guess, should we consider starting that nonprofit for ourselves?
So I would say you have to be passionate about something. Mm-hmm. So if you're passionate about something, then I would say start it before you even worry about the money. And I'm not just saying that because we set it up, but because there's the old adage of what comes first, the chicken or the egg. Well, I tell you what, if you have the vehicle, you will find the use for it. We see that over and over and over again. So I sometimes use Marriott as an example. Marriott started off, the big, huge hotel chain, started off as an A&W root beer stand. Hewlett-Packard was a couple guys in their garage. They didn't even know what they were going to do. Sony was a toaster manufacturer. Motorola was a battery repair shop. Like, you have all these companies, and they found the way to be successful, but you had the company first. And so I say, if you have a passion for something, then you're still going to get a benefit out of the nonprofit. They don't cost much to operate. In fact, I just did California this morning on one. It was $30 to file. And, you're going to have a little bit of elbow grease. You're going to have to hire someone to do the application, the 1023. Yeah, it's a little bit of time, but you're talking about a few thousand bucks. That's what it's really going to cost you. Let's just say it's 35 on your tops. That is just about depending on your tax bracket, that might be a $10,000 gift that I can write off now that I wouldn't have otherwise been able to write off. And I'm in control of it. And I can do so much good with it. We have folks that build houses all over South America. We have folks that build houses here in the United States. We have folks that provide housing for folks. A great one was transitional housing up in Seattle. It was a gal that had been affected. Her daughter had dependency issues, and she was just with the governor, and they're giving accolades to her nonprofit. And what they do is they literally give her about $850 a bed per house to house women who are in transitional housing. And get this, so she has 5 houses that I know of now that all house about 10 women per house, and they have a laundry list. They have about 100 people waiting for her to get more houses for them. And she did that through a single nonprofit, and the nonprofit doesn't provide the housing. She does in her for-profit enterprises. You have to understand that these things really are powerful vehicles. And I'm not here to try to tell everybody to do a 501c3. I'm just saying if you have a passion for something, quite often it's better for you to do it rather than you just give money to somebody else and hope that they do it.
Wow. No, that's very interesting. I'd love to ask more about that, but unfortunately we're running low on time and just want to get a few more questions. But Toby, what's a way that you've recently improved your business that we could apply to ours?
Oh, wow. That's a really good question. You know what? It's all coming down to technology and reaching out to other people. So if I was going to say that there was a stumbling block for us, it's really been hiring people. The job market's really tough. And what you're realizing is that the more you break down barriers to communicate with your clients, the much better off you're going to be. And so things that we do is like, I could tell you that the Tax Tuesdays has been great. We're on pretty close to episode 100. So it means that we've been doing it for a little while. But really recently, we started really focusing on letting everybody have access to it. And it's something that we don't charge for. But what I find is that it allows the free flow of information to go much, much easier. And I would say with anybody, you want to take down the hurdles of getting in communication with you. You want them to be able to get answers quickly so they can make decisions quickly. And if anything, it takes the burden off of my staff because I have accountants that would be answering these questions. And I can tell you what, when I do a Tax Tuesday, we answer about 200 questions. Wow. So what I just did is took, I don't know how many of those would have been on my staff, but let's just say 100 of them would have been on my staff. I just took away a lot of their work because between me and my senior tax CPA, we can handle most of the questions. I've heard a lot of these things before, so we're just knocking them out left and right. Whereas somebody else would probably have to research it, and then you're getting an email and they have to type it and all this stuff. Whereas, hey, I can just answer your question. What's the ramification of doing this? Oh, interesting you ask, because here's the actual rule. Boom, you just get an answer.
Nice. No, I hope the listeners will check that out. That's awesome. And Toby, what's been the one thing or most significant thing that's contributed to your success?
You know what? I think it's doing what your clients do. The one thing because I can talk your language and I know what you're going through, and because I go through it too. If there was one thing that I learned early on, and I had a really great mentor, and he didn't like lawyers. And so his son became a lawyer and I became a lawyer because he says, please become a lawyer so I don't have to deal with lawyers anymore. He goes, they're always telling me what to do and none of it makes any sense. So I was just really lucky to have a guy that taught me business before I became an attorney. So that when I became an attorney, I was just working for all the people that I was working with before. And they were like, finally, someone who speaks my language. So I'd say that's probably the most successful thing is that the people here, all the partners, ran businesses before they became attorneys. So we know what it's like to make a payroll. We know what it's like to invest in things and have that anxiety of when is it going to come back. We know what to look for. We're used to seeing all the paperwork. We've seen just about every pitch you could think out there, and we know what the red flags are. So when you see it, you say, all right, here's what they're doing. Here's your good side, here's your bad side, so you can make an intelligent decision. It's like selling a business. If I sell the stock, it's great for me. If I sell the assets, it's great for the buyer. There's actually a way to do both. Most people always think it's one or the other. So they'll actually have a deal that'll fall through because somebody just doesn't know the nuance that there's a little code section out there, 338 H8 and H10, that allows you to treat both ways. Well, most attorneys have no clue of that. And most CPAs, unless they've done mergers and acquisitions, have no clue. So they're just going out of the book, which says, hey, you should always sell your company, sell the capital asset, the stock. And of course, the buyer says, well, I want to be able to depreciate it. So they want to buy the asset. It's just knowing that there's always another answer in there. There's a way to get there just about on everything. It's just knowing enough to know who to ask.
Got to know who to ask. We can't be experts in everything, can we?
No.
So, yeah, Toby, and before we have to go, how do you like to give back?
Oh, me personally? So I work with a ton of nonprofits. I'll tell you what, Meg Boozing is this awesome one. She just did a TED Talk. She came to me, she was making about $10,000 a year. She'll tell you her story, but she thought that she could never do her own thing. And of course it was a client that referred her to me. And so we just did it pro bono. I said, hey, I'll take care of it, Meg. She was a gal that did an epilepsy camp in Omaha. And they just did another one. My daughter actually volunteered at it. She's a neuroscience major who graduated from college recently, wants to go back to med school. So I said, hey, go to this camp. So she went out and did that. I just love those situations where somebody's doing things like that. So I do that. And then I work with a lot of nonprofits. King's Ransom's awesome. They did 1,500 houses down in Nicaragua. You build it for the extreme poor. There's just so many of them, all good works. I could just start battling them off because we've done about 3,000 nonprofits. So I believe and I won't waste your time on this, but this is a really good read. This is from Andrew Carnegie back in, I think, 1899. It's called The Gospel of Wealth. You do yourself a huge service to read it, because you'll realize that, that millionaires are trustees of the poor. If you make money, then you should be taking care of those that don't. Like, a lot of times we have this spite thing where we're looking at it and it's almost like this, like there's class warfare. It's like, no, if you're successful at making money, make a ton of it, but help other people. You don't need it all for yourself.
Love that. I will definitely look that book up for sure. But Toby, you've been a great guest. I can't thank you enough, but tell the listeners how they can get in touch with you and learn more about your business.
Oh, just go to our website, andersonadvisors.com. You could always Google me. I'm not going to give you a bunch of phone numbers and things like that, but you can just go out to our website. Feel free to join Tax Tuesday. You'll find it out there. If you just Google Toby Mathis, you'll see a whole bunch of stuff. I've been doing this for over 20 years and love to teach. That's how I always look at it. It's like, if somebody knows what they're doing and why they're doing it, they're a great client. If I'm just doing stuff for people, they have no idea why they're doing it, usually there's going to be conflict.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.